Good day, folks. I just want to welcome everyone to today's webinar. I'm really excited to have Mr. Dale Sherman from Kinetic join us to share his cost and schedule of risk analysis procedures that he uses in conjunction with that risk. Dale Sherman is a Kinetic Fellow and a Head of Profession for Cost Engineering in Kinetic Advisory Service. He's presented a variety of training courses around the globe and is the author of two books. One is Systems Cost Engineering and the other is Cost Engineering Health Check. How good are those numbers? And it is my pleasure to introduce him today to just share with us for the next 60 minutes or so. So I'm going to go ahead and change the screen over to you, hand you the controls so that you can take it away.
Welcome everybody to this presentation, this webinar. I'm going to be talking around at-risk as a product and how we apply it in Kinetic in association with cost and schedule risk analysis for projects. The outline of the presentation that I'm going to give is a quick introduction to myself and Kinetic, and then look at the terms that we use. That's important because that's going to be the foundation of what we do when we look at the analysis of risk. We're then going to start by looking at solely and only cost analysis, then develop the schedule analysis, and then we're going to look at what happens when we combine both cost and schedule analysis together and the interpretation of the confidence levels, and then just wrap up the session with a summary. So Kinetic as a business has three businesses which are domain focused: air and space, maritime, land and weapons, cyber, information and training. We also have an organization, a business in North America that supports that market. We have an OptiSense company which is providing security and border security following research that we've done on fiber optic cables. And then we have an international business as well. The bit that I work in is an external consultancy business within international. So my background is in costing, estimating, forecasting. It's very boring. That's all I've done for about 30 years. But in the process of doing that, I think I've got a fairly good understanding of how to do it, and particularly the area of risks and uncertainties. I'm involved in a number of organizations, won a number of prizes, and I think I'm a pretty good understanding of exactly what cost and schedule risk analysis is all about, which is what I want to share with you right now. So the definition of the terms are important. And people use terms interchangeably, but I believe that we need to understand them completely to really get a grip on what it is we're doing when we do the analysis of risk analysis. So we're going to put risk analysis in the context of the whole risk management process. When we're talking about risks, what we're really discussing are problems, formalization of problems in a project. So at the beginning we have to establish the context, we have to identify risks, we have to analyze them, evaluate them, and then treat them. And to me it's a problem-solving process, and it's about communications. We need to monitor and we need to review them. But that's all it is. It's a formal process for solving problems in a project context. At Kinetic we have a risk maturity model where we're able to look at organizations and determine how good they are doing this risk management process and how well that they actually address the risks within the projects that they have. But the bit that I want to talk about this afternoon is that bit right in the middle, the analysis of risks and how do we consider them. So let's start with some definitions. So the first thing really is to realize that a project has a baseline, a deterministic idea. The simplest example I can give you is going from work to home. Okay, so I'm at work and I'm going to travel home. That classically takes me 20 minutes. Am I going to do that task? Am I actually going to leave work? Hopefully at some stage I will, and go home? Yes, so the probability is 100%. If we consider these definitions in terms of probability and impact, then that's a good way of looking at them. So my baseline is I'm going to do an activity. I'm going to leave work, travel home. Probability of my baseline plan being executed is 100%. We're going to do that. The impact for my deterministic estimate is the most likely. It will typically take me 20 minutes to get home. Now, if we consider uncertainty in that context then, uncertainty it's the noise, it's the potential range of answers that I could give if you ask me, how long does it take me to get from work to home? So classically what we do is we use a 3-point estimating technique. The probability is still the same. It's the uncertainty around that baseline. I'm still going to leave work and go home. But if we think about it, if I do that task 100 times, I can consider the range of outcomes. If the traffic lights are all green and if there's no other cars on the road, then it may take me only 15 minutes. That might be my minimum time to get home. Conversely, if the traffic lights are all red and the traffic is very busy, then it might take me 30 minutes to get home. So I can start to establish a 3-point estimate, a minimum, a most likely, which is the same, and a maximum. Now that's fundamentally different to a risk. In terms of probability and impact, a risk is a deviation from that baseline plan. So when I leave work, I don't intend to go on the freeway or the motorway to get home. I intend to go direct by the most direct route. But there's a chance that my most direct route is blocked by an accident or there are roadworks and I have to go the long way around to get home. I never planned to go the long way around. Therefore, it's a risk, and the probability is going to be less than 100%. So risks are things which are less than 100%. They are deviations from that baseline plan, and they have an impact. So I don't plan to go the long way home. I plan to go straight home, no problem at all. But there's perhaps a 5% chance that when I leave, there's been an accident and I have to go a long way around. If I do, that 5 in 100 chance that the outcome is going to be an even longer trip. I'm going to have to take even longer to get home. So those are the definitions we're going to use here. Okay. The final one I want to just consider at this point is also mitigation. Okay. And this is an interesting area when we're thinking about risk and uncertainty. There are opportunities to mitigate the risks. Now, if we decide to mitigate those risks, what we're trying to do is either reduce the probability or reduce the impact, or both. But the trick here is recognizing that a mitigation is 100% probable and it has an impact. And we can only reduce the risks once we've funded or considered the mitigation actions. So we'll consider both risks which are before mitigation and risks that are residual after mitigation, and use it in that context. Okay, enough of this. So let's just refresh ourselves. I'm going to consider the impact, the 3-point estimate, as a triangular distribution, as I've defined here. And this is the uncertainty around my baseline activity. And I can do it either as a schedule, or I can do it in terms of cost or resources, effort. What we recognize is that the probability distribution represents the most likely point at the peak with the minimum and maximum on either side crossing the origin, which is zero probability. In at-risk, we can define those as a triangular distribution. It's very easy to do in a spreadsheet. So we use the equals risk function, equals risk triangle function. We define the minimum, the most likely, and the maximum. The most likely then is the genuine expert opinion of the typical resources or time required to complete that baseline task. Naturally, we assume normal working practices here. We recognize that sometimes we don't get tasks right first time. But if we were pressurized, if we were pushed, that point with the peak is the answer which we would give most frequently. If you ask me how long does it take me to get from work to home, I will say 20 minutes. That excludes any contingencies or any uncertainty. Now then, if we look at the maximum then, the maximum is genuine expert opinion as to the worst case in terms of resources or time that we're going to consume. It's the largest possible estimate. And the trick here is realizing that it hits that zero confidence, that zero probability. So if we can conceive, if we can think of a scenario where there might be more effort or more schedule or more time required, then it's not zero probability and the maximum needs to be moved to the right. So it recognizes this as the worst case plan. And again, it excludes deviations here. We're only considering the possible outcomes of our baseline plan. So we're not considering any risks, any deviations from our plan. This is the maximum, genuinely the maximum time or resources we require to complete this task. Conversely, the minimum is just the other side. It's the best case. It's the quickest time I can get home. Very straightforward, very easy. It's just the opposite end of this probability distribution, this triangle. Before we move on, the final distribution I want to consider is this one, which is a discrete distribution. And we use this in a particular case, as we'll see later on. And what we do is we represent, when we're modeling, a 0 or a 1 as the outcome, the likelihood, the probability of a risk occurring. We said a risk is less than 100%, so sometimes it will occur and sometimes it won't occur when we're creating a model of the uncertainty and risk. So this is a mechanism for us to define what proportion of the time, what probability we have that the risk occurs or the risk doesn't in our planning. Okay, and we can define that again in at-risk using a discrete function. In this case, we're saying 70% of the time it will result in a 0, and 30% of the time it will result in a 1. So it's as if we're using this in a mathematical sense, 30 out of 100 times it will result in the number 1, the risk is occurring. And you'll see this in a moment. Right, so how do we develop then a cost analysis? We've taken a very simple structure, a very simple project with two subsystems, A and B. We develop that further and put some work around those two subsystems. What do we have? We have essentially 8 tasks. Task 0 might be project management. Tasks 1 to 6 may be design, manufacturing activities, and then perhaps task 7 is the integration. Regardless of what it is, they're tasks. There are pieces of work we intend to do to actually deliver this project. We can very simply put them in a Microsoft project and create a schedule if we want to. Or we can use it to create a network. We can identify the activities going from the left-hand side to the right-hand side, all the things we need to do. Now, if we're thinking about this in terms of cost, then we need to allocate resources to this. The first thing we're going to do is do it deterministically, a single point estimate. So very simply, all I've done is I've put a number, a unitless number. This can be dollars or euros or pounds, but a number, a resource to each of the tasks. And in a spreadsheet, it would look something like this. We have tasks 0 to 7. The probability of those tasks being completed is 100%. They're our baseline. And the resources that we're going to consume, in this case, absolute deterministic, we can identify them from the network. We have to do all of them. We add them up and they come to £330,000. We can plot that at the bottom as our point estimate. Now, if we want to consider uncertainty, because the only thing we know about £330,000 is it's wrong. The outcome of this project will be, when we've actually executed it, typically somewhere around 330. So we need to look at the uncertainty around this baseline plan. So I've taken the most likely and I've given it a minimum and a maximum in each case. Very simple example again, I appreciate that. But in each case, what we have is now a 3-point estimate for each of the tasks. So if we look at the next slide, what we're able to do here then, at the top half, from the most likely, that adds up to 330, we have a minimum, we have a maximum, and we have some at-risk functions which are going to be used with Monte Carlo analysis to create an S-curve. Now, I love Monte Carlo analysis because it sounds really interesting, and as a consultant it can make you a lot of money, but believe me, it's not frightening and it's not difficult. Monte Carlo analysis, when you understand it, is very straightforward, very simple. So down at the bottom here we have our deterministic estimate and we have an uncertainty. And we've plotted that uncertainty as a blue S-curve, which shows essentially the difference between the confidence at 0 to 100%. Now, how do we interpret this? Well, if we have a project manager and we give him £380,000 over here on the right hand side, he's got 100% confidence because all of the project outcomes are going to be less than 380,000. Any scenario, any uncertainty in those estimates, he's going to be on a winner. He's got 100% confidence. Conversely, if we go down to £320,000 and give him a budget of 320, he has absolutely no chance of bringing this project in on budget because all of the uncertainty is to the right. It all falls to the right of £320,000. So he has absolutely zero confidence that he's got enough money. We draw this using a risk percentile, which again is a function within at risk, and just drawing out the percentiles that we're looking for. Nice and easy to do. What does Monte Carlo analysis mean then? This is a simple explanation. Anybody can follow this. So I've identified, just taken 3 tasks, and I've created 3 triangular distributions. The first one, I've said the minimum is 8, the maximum is 12, and the most likely, the point of highest probability is 10. And what we're going to do in at-risk is we're going to generate 1,000 iterations or more of random numbers which represent that distribution. So the majority of the numbers will be taken around that central point, around the most likely, around 10. But occasionally it will go out to 8 and 12 and take samples out there as well. So my first calculation, when I set the software working to simulate, the first calculation, it takes a random number within my triangle and it comes up with 8.5. At random, it's taken something from the left-hand side. The next one then, task 2, is taken from the right hand side. It can choose anywhere between 15 and 40, with the most likely as 25. Here it's taken 38. Task 3, it's chosen 63. What we do is we simply add up all those numbers, we get to 109.5, and we store that in the memory of the computer. That's one iteration completed, one sample, one possible scenario, one possible outcome of this project. We said it could be anywhere within those distributions, and all of those numbers fall within those distributions. So 109.5 is one possible outcome which we could conceive. Now the second iteration, we set it off going again. It picks another set of random numbers, iteration B if you like, and it comes to an answer of 103.5. Again, it saves that answer. We do it for iteration C, the third iteration. This time it's skewed towards the left, it doesn't matter. The answer is 86. That again is another viable, another possible outcome of this project. And we carry on doing this. D, E, F, we do it 1,000 times, and we create the result that we get at the bottom, this probability density. And what we then do is we take this probability density and we slice it up, make it into a cumulative density, and that's what forms the S-curve. So at the left-hand side of this result, that is essentially zero confidence, because nothing is going to fall to the left. All the projects are going to fall, all of the possible outcomes of this project are going to fall to the right-hand side of there. If we take all of the area under the curve and we come over to the far right-hand side, then this is our 100% confidence point when we convert it into an S-curve, because all of the project outcomes fell to the left of that budget. So that's how we do Monte Carlo analysis on uncertainty. So let's introduce risks now. So I've made it very simple. I know this is a simple example. I've just taken one risk out of a risk register, one risk for one task. Okay. So in addition to the baseline plan that I have, the baseline network in blue, I now have potential deviations. I don't want to plan for those deviations, but there's a possibility that I may have to fund the work on those risks if they occur. So I need to define them. They're going to be less than 100% because they are risks. So I have a risk and an impact 3-point estimate. So for example, risk 1 is for task 1. There's a 10% chance of risk 1 occurring. If it does occur, what's it going to be? Well, it's going to mean that we're going to spend somewhere between 0 and £7,500, with the most likely being an impact of £5,000. If that risk happens, I need to be able to find, as a project manager, that money to correct the problem and put myself back on track to continue this project. So how do we model that? Well, here we see the spreadsheet developing nicely. At the top here we see the tasks and the uncertainty. In the middle then we see the probability. And now we see a probability, we see the risks, and here we see probabilities that of course are less than 100%. And we see the impacts should those risks occur. We've plotted the risk which is pre-mitigated, and we've plotted it in green on our chart. Again, so we now have a deterministic answer in red, the uncertainty around our baseline in blue, and our pre-mitigated in green. So how do we model this? This is where we use the discrete function. So for risks, I've just taken 3 risks. Risk 1 has both an impact as a triangular distribution between 10 and 50, with the most likely being 40, but it's multiplied by the probability. And in this case, the probability is either a 0 or a 1 when it's simulating. If it's a 0, then the risk didn't occur. If it's a 1, the risk occurred. And in this case, it's a 50-50 chance, indicated by the bars being equal level. So in 100 iterations, 100 simulations, what we're going to do, we're going to find 50 times it will be 0, and the software will create 50 times it will be a 1, as if the model's suggesting the outcome of a project where the probability is 50-50. So let's just run through this. So iteration A, the first iteration, is a random sample. Did it occur or didn't it? In this case, the iteration A is a 0. The risk didn't occur. So it doesn't matter what the impact is on the left-hand side. Anything times 0 is 0. The risk didn't happen. We don't need to fund anything. If we look at the second risk then for this iteration, then in this case we're saying although it was a low probability, this risk actually occurred. And the impact here we're a bit uncertain about. We don't have a most likely. We're just saying uniformly it's anywhere between 20 and 60. So this is a uniform distribution. And in this case, it took a number of 45. So 1 times 45, calculated, we need to be able to fund £45,000 in terms of putting this risk correct. The final one then, risk 3, in this case it didn't occur, 0. So we add up what we need for this iteration A, 45, we store it in the computer memory. Now, just as before, we can move on, reset everything. Iteration B, in this case again, iteration B, the first risk didn't occur, the second risk, this sample didn't occur, but in this case, risk 3 actually occurred, and we know for certain it's a fixed price fix, if you like. All we need is £30,000 and it's going to be put correct. So all it's got there is 30 to add up, and again we store it in the computer memory. Move on to the third iteration, iteration C. Risk 1 occurred, risk 2 didn't, risk 3 did. We can add it all up. In this case we require £60,000, $60,000 to actually put the risks that have occurred back on course, put our project back on course. We need to fund these impacts. Okay. So that's how we can do risk analysis using Monte Carlo analysis. It's not tricky, it's not difficult. Let's consider then post-mitigation. Alright. So the fun here is what we've done is we've introduced mitigation actions. And again, it's extremely simple. One mitigation action for one risk. Now, what we need to establish, of course, is that the risk has now reduced in terms of its probability of occurrence or its impact, or both. In the case of risk 5, the mitigation action is so strong that we can determine that there is no residual risk afterwards. So if we actually fund this mitigation action, risk 5 just disappears. So what do we do here? Well, the spreadsheet grows naturally, but at the top we're going to look at again, there are tasks that we're doing, 100% probability. We have to recognize then, post-mitigation, the mitigation actions have to be funded. We have to actually do these mitigation actions to be able to reduce the probability or the impact of the post-mitigated risks. What does that look like on a chart? Well, now we're introducing that purple line. The purple line is really that uncertainty moved to the right, we're having to fund, we must fund those mitigation actions, so the whole program is going to cost us more in this case. And then, of course, what we can add is the light blue line, which is the residual risks, the risks after mitigation, post-mitigation risks. Now, I realize that that's really a very simple example, and what I've done is all or nothing. Okay, and in the real world, what we have now is a transparent analysis. We have the ability to pull through the risks from the risk register transparently into this analysis. And, dare I say it, project managers have the ability to proactively manage their projects. They can actually decide, do they want to invest in mitigation actions? If they do, what might be the outcome? If they don't, what might be the outcome? If they do nothing, what's going to happen? They're going to follow probably the outcome somewhere along the confidence of the green line. If they fund some or all of the mitigation actions, they're going to spend more money, but then they may reduce the outcome in terms of the risk post-mitigated. So we have transparency. Nice and easy. Now, this is going to be relevant later on, but a lot of organizations pitch their budgets at 50th percentile. Okay, 50th percentile they choose because, well, if you do enough projects, some you win and some you lose. If you give your project managers a budget at the 50th percentile, you're not giving them an overly easy time. They know that half the time they're going to overspend, but neither are you giving them a really difficult time. They have at least some chance. Some of the projects, some of the iterations actually fell to the left of that budget. So 50-50 chance. Now this is important when we look at the end. We'll be coming back to this. But just bear in mind that 50th percentile represents half of those projects, half of those simulations falling above and half below that number. Okay, enough about cost. Let's look at schedule analysis then. Time. Okay, so time is slightly different, and we consider time in slightly different currency. We don't look at it in terms of obviously pounds or euros or dollars. It's more months and days. We can still consider it as a network. So I have my same network, I have my same tasks. And what I've done here, instead of money, is I'm putting in here some unit of duration, how long it will take in terms of perhaps days. Okay. Again, I can plot this in a spreadsheet if I wish to. Okay. So at the top here, what I've got, again, are all the tasks. They are my baseline tasks. They are going to be done. The probability is 100%. And the duration, how long does it take me to do them, are also indicated. But now to look at duration, what we consider, of course, is the critical path going through. So I've defined all of the paths through the network. We can go from beginning to end, just through 0, or we can follow the path 1, 2, 3. We can follow the path 4, 6, and 7, or 5 and 7. Now, in this deterministic estimate, what we then do is we look for the longest path, which in this case is 4, 6, 7, which has a duration of 13. That longest path is the critical path, and where you would establish that the project will end. It will finish in 13 days' time on a deterministic. So that critical path goes up through the top there, 4, 6, 7, with a duration of 6, 4, and 3, that's 13. If we put it into Microsoft Project, it'll tell you exactly the same, and it'll indicate where the float is in some of the other activities, other tasks. Okay, so in exactly the same way as we did with cost, what we're able to do here is we can do an uncertainty, a 3-point estimate with the duration as well. So we can put in here the minimum and the maximum to join the most likely that we've already determined. So in the spreadsheet, we can put the minimum and the maximum in, and we can use the triangular distribution again to identify the uncertainty. And we use the same paths through the activities. And when we do the Monte Carlo analysis, it calculates 1,000 iterations or more, however many we determine, and we establish what the longest path is across all of those. And again, we can put in the uncertainty in blue across our chart, this nice S-curve. Again, we can consider risk. So we introduce risk into this. Deviations from our plan. If the risks occur, they have a probability. If they occur, then they have an impact on the plan. They will take time to put things right. They will extend the duration of this network, but only if they occur. So again, we can create our spreadsheet, we can add to our spreadsheet and develop it, and we can see the risks here. And the risks have a probability, naturally, that are less than 100%. We don't plan to do these activities, but on the occasion when they actually occur, then our network will take longer. So down the bottom here we have uncertainty as before, but we also have pre-mitigated risks now, transparent straight through from the risk register. So now we have a different outcome, and it looks like that path 1, 2, 3 is going to be the longest, most critical path in this simulation. When we simulate it, obviously what we see is an S-curve again. So we can add that green S-curve in there, which again is pre-mitigation. We read it in exactly the same way. So if we have a delivery date, remember this is time now, if we have a delivery date and we set our project manager to deliver our project in 20 days, he has absolutely no chance, zero confidence, because all of the outcomes, when we consider the uncertainty and the risk, mean that it would be in excess of 20 days. Similarly, if we give him something like 65 days, then he'd be a very happy person, because at 65 days there are no potential outcomes greater than 65. He would have 100% confidence that it didn't matter what risks matured, what risks were triggered. He would have enough time to correct them, mitigate those risks and put them right. Okay, so then we can do exactly the same with schedule as we did with costs. We can introduce mitigation actions. Actions which will reduce the chance, the probability of the risk occurring, or the duration of that risk, the impact of it. Again, it needs to have reduced. So these are the residual risks once those mitigation actions have been put in place. Again, just drawing out and developing the spreadsheet some more. We now have tasks at the top. We have the mitigation actions. Again, they have to take place. We have to program them into our network. They are 100% probable. We have pre-mitigated actions that we had before and post-mitigated actions as well. And again, we can bring them in, we can add them, we can model them into the spreadsheet to make this very simple analysis. So what we've now done is we've added that purple S-curve, moving the unmitigated, moving the uncertainty, the blue line to the right, adding the duration, the time it takes to do the mitigation actions, and then recognizing that there is some residual risks thereafter, so there are some post-mitigated risks as well. So that light blue line, again, is the post-mitigated risk situation. How long it might take if we invest in those mitigation actions, and again, completely transparent. Your project manager now has the ability to consider what if. What if I only consider some of these mitigation actions and let the risks mature on the others? No problem, we can model that. And again, quite frequently we see organizations that pitch at the 50th percentile for their schedule risk analysis. Okay. Again, they would say that they will deliver somewhere around 31, 32 days, and they'll have a 50-50 chance of actually delivering that, because some of the projects, some of the iterations will be higher and some will be lower. So I just wanted to develop this further and think of combining cost and schedule risk and why we might do that. Why might we consider the combination of the two? It seems quite rational to do it separately. Well, in the world of projects, we have to realize that there are task-related activities and then there are duration-related activities. So if we're talking about tasks, to design something, to manufacture something, to build something, fabricate it, those are fine. But then we have the overhead of things like project management, project control. If the individual task activities extend, then the other thing which happens is the project management, the project control staff, and all those overhead activities also extend. So there are times when there's a knock-on effect of a task extending in time when we relate it to the overhead activities. So the way we've considered this is to look at the duration in the horizontal, the x-axis if you like, and then vertically we're considering the rate of expenditure, the amount of money we spend per day or per month or per year, however you want to look at it. But there is a rate of cost consumption. And you'll see how this works as we work our way through this slide. Again, we can define them as 3-point estimates if we're considering uncertainty. We're going to begin. We know that the baseline activity, 100% probable, we are going to plan to do this. The question then is, what's the uncertainty around that? Well, if we put a red arrow in here to indicate one iteration, we can have an outcome in terms of the difference in the rate of cost expenditure per day or per month or per year. And in this first iteration we can have a duration, which is just to the left of that most likely. So what is the likely cost of this first iteration? It's essentially the area within that shape. It's the duration multiplied by the cost per month, per day, per year. Now we can also look then at risk in a similar way. So we've got our baseline estimate and we understand for this first iteration what that might cost. If we consider then a risk which has a 30% chance of actually occurring, it's going to occur 300 out of 1,000 times. We throw the dice. Then again, we can consider that there may be a duration extension and there may well be a cost extension because that risk has occurred. Something has happened to our baseline project which is going to force us to spend more money, and it might take longer to actually complete that task. We can look at one simple iteration, again with the red arrows, and there we have the outcome, 30% chance, 3 out of 10, it's actually going to cost us a lot more than our baseline estimate. So to understand the concept, we can actually consider the combination of schedules extending and time and cost extending as well. Now the important thing here is the interpretation of that when we consider what our confidence is and how we are thinking about this in terms of managing a project. I was given this analogy by a colleague of mine. Richard Cousins came up with this, and it's about tossing a coin. So we all know if we flick a coin and we call heads, if we call heads and it lands on heads, then we win. If it lands on tails, then we lose. Well, that's very simple. That's very easy to understand. When we combine and think about that in project terms then, if we're doing cost and schedule analysis separately, in a project you win when the schedule is on time or before the milestone that you've set. You also win, if you're doing it separately, when the actual cost incurred is less than the budget that you've set. The difficulty comes then when we think about tossing two coins. So if we throw two coins up and we call heads, we only win when both coins fall on heads. If one falls on tails, we've lost. Or if they both fall on tails, we've lost. So that's essentially what we have when we're considering combined cost and schedule analysis. You win when heads is called and heads are actually occurring on both coins. In project world, that means that you only win when both the cost incurred is less than the budget and the schedule is prior to the milestone that we predicted. Essentially that bottom left-hand quadrant. Anywhere else and we're losing. So how do we do that then when we combine schedule and cost risk analysis? Well, here's a little example and how we can interpret it. So across the horizontal, the x-axis, we've got duration, we have schedule outcome. And on the y or the vertical axis, we've got some project costs. And the blue arrow is giving us a first iteration, one possible outcome of our project based on risk and uncertainty as we've been discussing. If we let the model run and we have a few more iterations, we can add 10. We start to get a pattern. We add 250 iterations. Now we have something which we are beginning to understand. 500 iterations, and we're beginning to really get the picture. And at 1,000 iterations, we've got quite a big cloud. Now from here alone, we can tell a few things. If we just look at the duration on the horizontal axis, we know that no projects fall before 4, and nothing really falls after 13. We know that nothing is above 47, and nothing is below, say, 17 in terms of cost. So we can start to see where the confidence levels are here. If we put a line down the middle then, and we make sure that half of the outcomes are to the left and half are to the right, there are 500 dots to the left of that line and 500 dots to the right. In other words, that represents our 50% confidence. If we set our project manager off and he's got a duration of 8 days to get this project done, or 8 years or 8 months, he's got a 50-50 chance. Half of the projects, if we were to do them simultaneously, would end up before and half would end up after that 8. If we think about it in terms of setting it then, this is our 50th percentile on our schedule risk analysis. If we slice the data in the other direction then, and we set it somewhere around 30 in terms of cost, again, half the points are above and half the points are below. So we've got half of the projects potentially coming in under 30, and the project manager is a hero, and half of them coming above 30, and guess what? The project manager gets fired. So that's really our 50th percentile in cost risk analysis. Now if we go back to our throwing of coins, of course what we realize is that if we combine the two together, we're only a winner when we're down in that bottom left-hand quadrant. Because anywhere else, we're either exceeding the time or exceeding the budget or both. So only in that bottom left-hand quadrant do we come in delivering our project in time, within our milestone, and within our project budget. So if I color code these, make it a bit easier to see. Here's my 8 duration and my 30 in terms of cost. If I put some numbers to this then, here's my independent 50th percentile, 50th confidence level for my schedule and my cost risk analysis. When I combine them, what I then see is, of course, the bottom left-hand quadrant. There are only 280 projects that fall into that quadrant. This project manager, if we set his project up like this, only has a 28% chance of succeeding. He only has a 28% chance of bringing his project in on time and under budget. Now, I don't know about you, but as a project manager, that's not pretty good. That's not good odds. I wouldn't be taking that project on. Thank you very much. If we move it up to the top right a bit, and where this dotted line is, anywhere on that dotted line, you will see that bottom left-hand quadrant having 50% of the points. So at that, we've got a 50-50 chance. 500 of the projects out of the 1,000 iterations, 500 fall into that bottom left-hand quadrant. And that's really where we want to be. At least 50. So we're giving him a 50-50 chance of success in terms of duration, in terms of cost. Interestingly, if we have a look at where that sits in terms of the individual cost and schedule risk analysis, it's around the 70th percentile. Okay, so if you're doing them individually to give your project managers half a chance, you really need to set it up there at 70th percentile or greater. So I'd like to draw to a close now and bring this to a conclusion.
Excellent.
What I'd like to say, my final thoughts, really, Monte Carlo analysis sounds impressive, but if you understand it and you appreciate it fully, then it's really as simple as rolling a dice. We need to ensure that we use uncertainty and risk terms correctly. A lot of people use them interchangeably, but it makes confusion. Really, project managers need to really embrace combined cost and schedule risk analysis to truly understand the outcomes of their projects and recognize that setting 50th percentiles at confidence in terms of cost and schedule is not going to give them a 50% chance overall. Hope you enjoyed the presentation, and I just thank you for joining me this afternoon.
And I just want to say thank you again, Dale, and thank you to everyone else who joined us. And I hope you have learned something. I certainly enjoyed the presentation without a doubt. So thank you again, Dale.
Okay. I'm glad everybody enjoyed it. Thanks and have a good day.
You as well. Bye for now.